What if I told you that the safest, most stable investment in the world, literally the foundation of pensions, retirement accounts, and entire countries, is starting to break? For decades, the bond market was a safe haven, but now it's a sea of uncertainty, with bond prices falling and yields skyrocketing at a historic price. That's why today, we're going to break down the mechanics behind this volatility, what's driving it, and most importantly, what it all means for the markets. My name is Lewis, and trust me, this is one video that you can't afford to miss. First things first though, there's something I need to make absolutely clear, which is that I am not a financial advisor, and nothing in this video should be considered financial or investment advice. This is purely educational content meant to inform you about bonds and bond yields. Now, if you want to get more content like this, then punch those like and subscribe buttons, smash that notification bell, and let's just get into it. Now, let's start by going back to the 1900s. Back then, the idea of a modern bond was still fairly new. During World War I, the US government issued something called Liberty Loans. These raised billions of dollars and introduced millions of Americans to investing for the very first time. The pitch was simple. By buying bonds, you were securing your own financial future while supporting your country during war, a patriotic duty, if you will. And that idea worked for generations. The government promised to repay what it borrowed plus interest, and it took that promise very seriously. This made bonds an attractive option for investors who valued safety above all else, like retirees or parents saving for their children's education. But what exactly are bonds? Well, let's start with the basics. When governments spend more than they collect in taxes, they need to borrow. To do that, they issue bonds, essentially IOUs, or promises to repay what they've borrowed with interest added on top. Bonds have a set due date to be paid off by, known as the maturity date, or just maturity, which could range from just a few months to as long as 30 years. Investors usually also receive a yield on the bond, like an interest rate. This ties into the relationship between prices and yields. Most bonds today can be traded on a secondary market before they mature, which means that their prices could fluctuate. Like any other asset, bond prices depend on supply and demand. More supply and less demand means bond prices fall, and bond yields rise. Conversely, less supply and more demand means that bond prices rise and bond yields fall. For example, let's say that you buy a government bond for $1,000 that pays a 3% yield, also known as a coupon. As you might have guessed, this means that you get $30 a year. But let's say that a few months later, new bonds hit the market paying 5%. Investors decide that they want to buy that bond instead, so the price of the bond that you're holding falls, let's say to $900. If someone buys it at this price, they still get $30 a year, but now that yield works out to around 3.33%. Of course, you don't have to sell. You can hold your bond until maturity and get your $1,000 back with interest. But the secondary market gives you the option to sell early if you need the cash. And it's this very mechanic that can sometimes turn supposedly safe investments toxic. A perfect example of this is the collapse of Silicon Valley Bank back in 2023. The bank was getting massive deposits from customers and decided to park that money in medium to long-term treasury bonds, which are the textbook definition of safe assets per financial regulations. But when the Fed raised interest rates to fight inflation, investors basically sold their bonds and the price of bonds fell sharply, leaving the bank with billions in unrealized losses. When customers began pulling funds, SVB had to sell those bonds at a massive loss to raise cash, which ultimately resulted in its downfall. Though that may have been an extreme case, it shows just how volatile the bond market could be. Long-dated bonds, typically those maturing in 10 to 30 years, are seeing less demand precisely for this reason. They are less liquid and therefore harder to sell during times of stress. Take Austria, for example. The government locked in historically low borrowing costs by issuing 100-year bonds in 2021. But once inflation took off, their price plunged by around 75% from the peak. That's the sort of decline that you'd expect from meme stocks, not from assets once considered really among the safest in the entire world. And that's why today we're seeing record issuance of short-term government bonds. As to why long-term bonds are crashing so much, Well, the short answer is that markets remain skeptical that central banks could keep inflation under control in the long run. Okay, so now that we've got a handle on what bonds are and how they work, let's move on to one of the most powerful signals in the financial world, which is the yield curve. Think of it as a graph that shows the yields of government bonds across different maturities. In simple terms, it tells us what markets are expecting inflation and the economy to do in the coming years. And that often gives a pretty big hint about what might be coming next. Normally, the yield curve slopes upward. That's because lending money for longer periods carries more risk. Investors want extra return for tying up their capital, given inflation risk, opportunity costs, and the uncertainty of the next 10 to 30 years. That's why long-term bonds typically offer a higher yield than short-term bonds. But in recent years, this graph has moved in reverse. We've seen the yield curve invert, which means that short-term bonds have been offering higher yields than long-term bonds. Now, while that might sound technical, it's actually a very powerful warning. Over the last 50 years, every US recession has been preceded by a yield curve inversion. It's essentially the market's way of signaling an economic slowdown. That's why when the curve inverted in 2022, recession calls were everywhere. Yet, after a modest scare in the stock market, the rally continued in 2023 and the economy held up just fine. Only now, after years of inversion, has the curve finally normalized. But what does all of this mean in practice? Well, rising long-term yields aren't just numbers on a chart. They directly increase the cost of borrowing, especially over longer time frames. Treasury yields are used as a reference rate for a huge range of other interest rates because they're considered a risk-free benchmark. And as those floor prices increase, they push up borrowing costs for everyone. We're talking about interest rates that directly affect everyday life, like mortgages, auto loans, even corporate borrowing. And it doesn't stop there. Higher yields also put pressure on the stock market. When government bonds start offering higher returns, they become more attractive than risky equities. And as a fun fact, equities have historically returned around 7 to 8% per year. So the closer that bond yields get to the average return of the stock market, the more attractive bonds become. The difference between bond yields and stock returns is what's known as the equity risk premium, which is the extra return investors demand for holding stocks instead of bonds. As that premium shrinks, investors begin rotating out of stocks and into bonds. But if that shift happens on a large enough scale, yields eventually fall, making stocks attractive again. Next, let's tackle the burning question. Why is the global bond market suffering one of the most severe sell-offs in history? Well, ultimately, it comes down to supply and demand. On the supply side, governments are issuing an unprecedented amount of debt. And this isn't just about the US. For context, Japan's debt stands at 225% of GDP. The US's sits at 120%. And Italy comes in at a staggering 138% as of Q1 2025. This flood of debt is being fueled by three main forces. First, we're seeing a surge in defense spending around the world, with NATO nations now required to allocate a minimum of 5% of GDP to defense. Second, healthcare costs and public benefits are climbing as populations age and birth rates sit at historic lows. Third, we're witnessing a new technological arm race in areas like AI and robotics. And yes, much of this investment is being funded with debt. But it doesn't stop there. The more debt countries take on, the more interest they have to pay. And in many cases, governments simply borrow more to cover the interest on their existing debt. This is why, in the US alone, interest costs are projected to rise from around 3% of GDP to over 5% by 2055. Meanwhile, the demand side is looking weaker by the day as buyers slowly disappear. For decades, the US and European nations relied heavily on foreign investors to buy their bonds, and they happily did because they were seen as low risk. But global perceptions of what counts as a risk-free asset have changed, especially after Russia's assets were frozen in response to the war in Ukraine. Now, countries like India and China have started slowly moving away from Western bonds and are buying gold instead. All of this buying has fueled an impressive rally in gold, which we've actually covered in a video right over here. Now, the result of this slow decline in bond demand has been a drawdown in bond prices globally. with the sharpest impact being in the West, since that's where much of this foreign capital used to flow into. So that means that it's where most of the outflows are actually coming from. This has resulted in higher borrowing costs for Western countries, both for individuals and institutions. To make matters worse, the idea that inflation would be transitory hasn't aged well, with global inflation still running about 4.3% and the real number probably much higher. So, to attract buyers, the US and its allies have little choice but to offer higher yields, pushing other countries to follow suit. And that's precisely why bond yields are surging while prices keep falling. Now, with governments sitting on a ticking time bomb of debt and a shrinking pool of buyers, the big question is, what can they actually do? Well, there are a handful of classic routes out of a debt crisis, but none of them are easy, and most are politically unfeasible. The first is fiscal consolidation, better known as austerity. That means cutting spending, raising taxes, or some mix of the two to bring deficits under control. On paper, this is the most direct and transparent solution, but in practice, with aging populations demanding more from social programs, almost no leader is willing to gamble their career on it. And that's why austerity has been shelved in nearly every major economy today. The second option is debt restructuring, or outright default. This is the nuclear option, effectively admitting a government can't meet its obligations and deciding not to pay up. Obviously, this comes with severe consequences, namely collapsing credit ratings, capital flight, and social unrest. For developed economies, default is seen as the very last resort, and one that they will go to great lengths to avoid. The third path is the more market-friendly one: liberalization and pro-growth reform. History shows that when governments open markets, streamline regulation, and encourage innovation, stronger growth can gradually shrink debt-to-GDP ratios without the pain of austerity. And if all of the predictions around AI and robotics do come true, well, we could be out of this debt mess in no time. I mean, jokes aside though, it's best to stay skeptical until we see it happen, if it even does. Now, the fourth and final path is financial repression. At its core, this is a toolkit of policies designed to make debt easier to manage without resorting to overly painful choices. Instead of cutting spending or defaulting, governments use more subtle levers to borrow at interest rates that are artificially low, oftentimes below the rate of inflation. Over time, the real value of what's owed shrinks, while the real value of savings erodes. The pain is spread so thin that most people barely notice, at least in theory. This is achieved through regulation, incentives, and sometimes outright mandates that push banks, insurers, and pension funds to buy and hold government bonds. And believe it or not, but this is already happening. In Europe, government debt is classified as risk-free, effectively encouraging banks to load up on sovereign bonds. In Japan, the government has leaned for years on ultra-low rates and a massive homegrown investor base to finance its enormous debt pile. Because of all of this, the era of independent central banking and global coordination is fading fast. We're shifting from a world of monetary dominance, where the central banks set the pace, to one of fiscal dominance, where governments and their budgets call the shots. The end result is that major central banks are now pulling in completely different directions. The Fed is cautiously cutting rates, the People's Bank of China is aggressively easing, and the Bank of Japan is finally tightening. So, what does all of this mean for the markets, and more importantly, for your money? These days, we're clearly living in a world that's more polarized than ever, with countries looking out for themselves and governments increasingly turning to desperate measures like financial repression. That means so-called risk-free assets, namely government bonds, are a guaranteed way to lose purchasing power. And it's not just individuals who feel it. Banks, insurers, and pension funds are effectively roped into helping governments raise money, forced to follow rules that put state needs ahead of profit. But this environment also creates opportunities. As we've seen, hard assets like gold and real estate have all kept pace with inflation, or in many cases, even outpaced it. And then there's crypto. Unlike many traditional assets, it looks well positioned in today's environment, where the old investment playbook simply doesn't work anymore. Inflation is stuck in an awkward middle ground, high enough to chip away at cash, but not high enough to push the global economy into a deep recession. Meanwhile, central banks are pulling policies in different directions, which only adds to the volatility and uncertainty. That mix of stubborn inflation and policy divergence is exactly the kind of backdrop where crypto, as an uncorrelated asset, tends to thrive. On top of that, structural shifts are setting the stage for meaningful inflows. With spot ETFs now approved and regulations taking shape, the foundation is being laid for institutional capital to enter the space in a way that we haven't seen before. Still, there are a couple of ways yields could affect markets in the short to medium term. If inflation cools towards 2% and we manage to avoid a full-blown recession, bond yields should fall. That should lower borrowing costs, lift valuations, and keep capital flowing into risk assets. On the other hand, a global recession could trigger a market crash before central banks step in with money printing. That would likely drive inflation back up, forcing yields higher again and pushing markets into another downturn. The key takeaway is simple. Whether yields rise or fall will determine not just the direction of the markets, but the trajectory of the global economy. And in today's environment, being passive may be the greatest risk of all. Those who diversify, stay alert to inflation, and embrace both hard assets and new instruments like crypto, specifically Bitcoin, will be best positioned to protect and potentially grow their wealth as this landscape continues to evolve. Let's just hope that we get out of this debt trap through growth and not through sky-high inflation. And if you'd like a deeper dive into just how severe global inflation has become, be sure to check out our dedicated video on that right over here. And if you haven't subscribed to the channel yet, you could do so right over here. Thank you so much for watching. I'll see you again very soon. This is Lewis, signing off.